First, let's note there are some basic similarities between marketplace platforms and traditional banking. Both look at the loans to try to make sure borrowers have the ability to pay before the loan is granted and to provide servicing after that. That is, they make sure any interest and principal payments are collected. However, there are several differences. Most platforms do not guarantee the borrower's repayment and hence do not take on the credit risk of the borrower or put its own money at stake. This is unlike a bank that absorbs the non-payment of bad or non-performing loans by subtracting the loss from its own capital. This means that the NPL platform's own balance sheet is not so important for the lenders to examine. There are a few cases where NPL platforms do hold the loans on their balance sheet and hence look more like a traditional internet bank. And there are a few platforms that provide some guarantee of repayment, but this business model is relatively rare. The platform does not earn a net interest rate margin, which refers to the difference between the interest that banks pay to depositors to attract funds and the interest they earn on lending the money out. Most NPL platforms use what is called an agent model that depends on retaining and attracting an investor base and generates fee revenue from borrowers and lenders to support itself, with interest on the loan passing directly from the borrower to the lender through the platform. The platform does not have a brick-and-mortar branch network, and so all the information it uses is collected via digital means. That is, the origination of the loan is done without meeting the borrower face-to-face. This means that decisions are based on predictive algorithms and machine learning techniques. Platforms collect digital information not just from the potential borrower, but from other sources as well, including from digital social networks, WeChat, Facebook, phone records, online spending behaviors, and so on, including the more traditional credit rating checks, criminal records, and other soft information that may be available online. A depositor in a bank has only a vague notion of where his or her money is going. A bank's annual report or other accounting statements may provide some broad categories of their lending activities, but typically it is impossible to isolate individual loans. In NPL, by contrast, the lender is usually able to know exactly where his or her money is lent. Indeed, it is the lender's choice, and often can follow the borrower's project and its profitability, or at least get a closer look than that provided by a bank's accounting statements.